Hi everyone, so welcome to the stream today. Very excited for having you, but very sorry also for the late start. In relation to that, we had some technical issues, so I needed to move to this place. Yeah, good evening, Audrey Daniel from YouTube. I believe you're doing well. Hi. Okay, so comment below YouTube with any questions you have, and be able to connect you for the stream. We are doing a live Zoom session. It's a live Q&A session. We are focusing today on financial reporting and also on corporate reporting. So whatever questions you have, you comment. Now, note that we are, for those of you who are on the Zoom call, note that we are streaming live on YouTube. If you have a question, you lift your hand so that you don't interrupt others. In that case, I see Jemima on the live call. I see Bernard, I see Solomon. So if you have a question, you lift your hand. You will see the options there. You lift your hand. So I call you, then you can come on. Sorry for the late start again. We had a technical issue, ECG Doomsop. So I got to move from my home to our office here for me to be able to do this live stream, because all my devices were actually at low battery. So there was no way I could do the stream from home. So that was why we got to delay a little bit. And hey, I gotta still make it for you guys. So you're welcome to the stream. Solomon, Bernard, Jemima, you are on the stream here. If you have any questions, you just lift your hand and then you will be asking the questions, and I will answer all your questions for you. Remember, we are streaming live on YouTube. So for those of you on the Zoom call, in case you have a background that you don't want to display, you can turn off your background in relation to that.
My network. If I put it on and it comes.
Okay. So Bernard, I see John, Edu as well. So Jemima. So we're going to go into the Q&A session very quickly in a moment. So if you have a question, all you do is raise your hand. You click on the, I think the more button or so, you will see raise your hand. And once you raise your hand, I'll call you to come to ask your questions, and I'll be answering. And for those of you watching on YouTube also, you can comment in the chat box with your questions, and I'm going to be answering all of them as well, because I'm reading all of the questions as well in relation to that. So we are focusing today on corporate reporting and financial reporting specifically, all right, on these two subjects, corporate reporting and financial reporting. So whatever questions you have in these two areas, just hit me with them and I'll be replying to all of your questions. Okay, I see a couple of people joining and also connecting up. Yeah, good evening. Ernest Ampofo on YouTube said good evening. If you have any questions, put it in the comment box. I'll be replying to all of your questions. All right, so those of you who are on the Zoom call, you are welcome to the stream again. It should be 4:30, but we had a technical issue There was doom saw in my house and all my devices were actually low. So I had to travel to our class here at the Akuman to be able to do the stream with you because I can't cancel the stream and then there is a lot at stake here. So if you have any question, you raise your hand or you click on the raise your hand button and then I will call you and you ask questions. If you are not talking, please turn off your microphone so that we don't have noise in the background. All right. Okay, so Jemima, I see your hand up. So give me a moment. I'm gonna mute this guy.
So good evening.
Jemima, you can talk. You are welcome.
Good evening.
I believe you are doing well.
Yes, please, I'm doing well.
Okay, so what's up?
Please, I want to know when we use IAS 27 and when we use IFRS 3, that's business combinations and separate financial statements. I see
Okay, you
it
want to
looks the
know when to use IAS.
IAS 27, that's separate financial statements.
Okay.
And it looks the same as the way we do the consolidated financial statements, that IFRS 3.
Yeah. Okay, so okay, let me see if I can get. Please turn off your mic. Turn off your mics. I see you. Let me try to mute everybody here. Okay. Yeah, so Jemima's question is that when do we use the IAS 27 and when do we use IFRS 3, the separate financial statement? Actually, they are a joint accounting standard in the context that when we are preparing the consolidated financial statement, on one side, each of the entities will prepare their separate financial statements. So let's say we have two groups of companies, company A and then company B. So, and they are all in the group of company called AB Group. So at the end of the day, A will prepare its separate financial statement, B will prepare its separate financial statement. But when we are doing consolidation, we are now merging the two separate financial statements, taking into consideration everything in the separate financial statement. However, now applying the consolidated principle, which is the IFRS 3 business combination, where we cancel any intra-group trading and also deal with any issue about current debtors and creditors outstanding between the two companies. The separate financial statements usually it's for how each of the separate companies within the group will prepare their financial statement, just like how any other company will prepare their financial statement. But for consolidation purposes, when we come to IFRS 3, we now bring the two companies together where we breach the rule of seeing them as separate organizations and now see the two companies as a single organization in relation to that. So the question as to when do you use this and when do you use that is that we use the separate financial statement when each individual company in the group is preparing its financial statement. And then when we are now preparing the single financial statement or the consolidated financial statement for the entire group, that is where we use the IFRS 13 in relation to that. So Jemima, that is the answer to your question. Does it make sense? Let's see my Zoom. Okay, I see Alice joining here. Where is Jemima? Okay, Jemima is here. Jemima, your mic is off, so in case you want to talk, you can unmute.
Okay, so
okay. I see Samuel Corti says, I believe you are doing well.
Sarah.
Thank you for joining.
Agree too.
Okay.
I'm enjoying the meeting.
Oh, okay.
I'm enjoying the meeting. Thank you for the opportunity. Thank you. Thank you. Hello, everyone.
Hi, so if you have questions, you know what to do. Please raise your hand in the more button. You will see raise your hand. You just raise your hand and I'll get the indication. Then I'll pick, I'll let you talk so that we don't interrupt a lot, okay? So click on the raise your hand in the more button. Then you will be able to talk so that we don't interrupt each other in that case. So I'll call you, then you talk.
Okay.
Okay, on YouTube, I am seeing a comment from Ernest Ampofo. He said, thank you for your support. Okay, Ernest, you're welcome. McPhail, Nana, are you talking? Okay, I guess some people are finding it difficult to just stay with us. I'm just gonna pin my video. So I stay in here. All right, so like I said, we were supposed to start this meeting at 4:30, but because of some technical issues down here, we're not able to start at the time because I need to move from home to this place to be able to do the live stream because ECG people have taken our lights this afternoon. Just uninformed about that. Please, if you have any questions, those of you on the Zoom call, raise your hand, click on the raise hand button, and then you ask your questions. We are focusing today on corporate reporting and financial reporting. So whatever questions you have in these two areas, just hit me with it, and I'm going to be answering all of them for you. For those of you watching on YouTube also, if you have any questions, you put it in the chat box. I'm reading your comments as well, and I'll be answering all of that. Now, Damilari said, good evening, sir. My question is on public sector accounting and finance. Okay, Damilari, we are not looking at PSA today, so put it down. Probably tomorrow or so we'll look at PSA and tax. So because today we just want to focus on FR and corporate reporting. So Damilari on YouTube, you can look at that. Now, Bernard, your hand is up. You can unmute your mic and talk. Bernard Covenant, you can unmute your mic and talk.
Hello, good evening, sir.
Hello?
Hello, good evening, sir.
Yeah, good evening. How are you?
I'm doing good, and you?
Yeah, I'm also fine.
Okay, so let me commend you for what you are doing to help us.
Please, your voice is a bit far. If you can speak louder a bit. As I was rushing, I didn't pick my headset, so I'll find it difficult to hear from you. So speak a bit louder.
Let me first of all commend you for what you are doing to support us.
Okay.
My question is in IAS 8, I think there were some issues when we were having some lectures, and we were told that in some instances, as the management board,
Bernard, I'm coming. I'm still finding it difficult to hear from you. So hold on a bit.
It's not too clear.
Yes, hold on a bit. I'm connecting a device for me to be able to hear you better. So please hold on a bit. Let me connect another device so I can hear you better. Oh my goodness. So let's see this. Let me just connect this device to the stream so I can hear you better. Zero, 1, 2, 4, 4, 6, 2, and 8. Give me a moment. I'll be okay very soon. I'm just connecting this headset so I could connect easily. Bernard, you can talk now.
Okay, sir. I hope you can hear me now.
Yes, I can hear you now.
Okay. So I was saying that in class we are dealing with IFA, which is in equity and accounting. We are told that there were some instances that as a manager or as the management board, you have to apply.
Bernard, I'm still finding it a bit difficult to hear. Like your voice is back. Sorry, it's far from your speaker. I don't know. Are you walking or something like that? Because I'm finding it difficult to hear. And I believe your colleagues are also facing the same thing. Speak again and let's see.
Hello.
Yes.
I hope you can hear me now.
Yes. Talk again and let's see.
Okay. So I was saying that we are dealing with IFA. I hope you can hear me now.
I don't know if you are walking or driving because there is a lot of air in your speech, so it doesn't make it steady.
Okay. Then sir, let me position myself very well before.
Okay. All right. Who else has any question? You can bring it up and then we go. Now, Daniel Oji, you are asking the meeting ID. It is 820-1244-6258. That is the ID, and the password is 936276. So this is on YouTube. All those of you who want to join the Zoom, that's the details there. Okay, so the rest of you, if you have any question, please raise your hand and then I'll call you in and then you can ask your question. Okay, you are welcome, Daniel. I don't know your name, but your profile name is the user laptop, so you can talk. A user laptop. You can unmute your mic and talk.
Good afternoon. Am I on?
Yeah, you are on.
Thank you very much. I am very happy to be part of this meeting.
Okay.
To commend you for the great work you're doing. I have a question. I believe you can hear me.
Yeah, I can hear you well.
Okay. I want to know the accounting standard that will be suitable for this scenario. For example, right now I'm in Togo.
Okay.
For example, I'm in Togo. My head office is in Nigeria. I trade in Togo, but the head office expects me to send my report in dollar.
Okay.
Please, I would like to know. Sometimes I experience some difficulties in reporting because due to the fluctuation in exchange rates. For example, if locally now my revenue for this particular month is, let's say, $1,000. I mean 1,000 CFA.
Yeah.
And the exchange rate is going for 600. Now I report that this month. By next month, let's say I make the same 1,000 CFA, and the exchange rate has fallen to 400 to 400. You see that what I report last month would be a bit higher than this month. Please, I would like to know what relevant standard can I adopt as an account officer to address that kind of issue?
All right. Excellent.
Please, can I hold mute? Can I hold mute?
Yeah, you can unmute. Now, the question you asked, I am sharing my screen now. It's in IAS 21. That is foreign exchange transaction. Now, this standard states that what you are doing is that you are in Togo and you have to send your report in dollars. What it means then is that you must have translating of the financial reports at the end of each period and sending the report. So what IAS 21 states is that when we are dealing with transaction, we must first look at the initial recognition. Now, so when it comes to the initial recognition, it means at the date that the transaction took place, you will use the exchange rate at that date to translate the transaction or to convert it from CFA to dollar or from dollar to CFA. Now, when it comes to dealing with this, there are two issues you must understand. That is treatment of monetary items and then non-monetary items. So we have monetary items and non-monetary items. Now, what are monetary items and what are non-monetary items? Non-monetary items are things like fixed assets, inventory. These kind of assets are non-monetary. So when you are translating them, you translate them at the exchange rate you used at the transaction date. But with monetary items, such as trade receivables, maybe the revenue figure, all of those things, you will translate them differently. Now, like you mentioned, there is always going to be a difference at the transaction date and then the year end. That difference will be referred to as exchange loss or exchange gain. So the rule is that according to IAS 21, there are about three exchange rates. Exchange rate at the date of the transaction, the weighted average exchange rate, which is the exchange rate for the whole year, and then the exchange rate at the end of the year. So this is how you translate your report from CFA to dollar. When it comes to the income statement, you will use the weighted average exchange rate to translate the income statement figures from CFA to dollar. Then when it comes to the statement of financial position, you will translate it using the closing exchange rate. That is the exchange rate at the end of the year or at the end of the period in consideration. So that the date that a transaction took place and the date that a payment was made or the day that financial statements are prepared, any movement in the exchange rate, whether positive or negative, will be treated in the other comprehensive income for the company under consideration in relation to that. So that is the treatment about your question. If it's about the translation of the transaction or financial statement, the income statement, you use the weighted average exchange rate, or yes, that is the average exchange rate throughout the period. And then for the statement of financial position, you would translate that using the year ended or the period ended exchange rate. Then whatever exchange gain or loss that arises as a result of the initial recognition and then the year end will be treated in the statement of other comprehensive income in relation to that. Are you okay? So you can unmute your mic, use a laptop, and then you can get talking. For those of you watching on YouTube, if you have any question, put it in the chat box. I'm reading all of your comments and we'll be answering them. And then also give us a thumbs up on the video so that the YouTube algorithm will be able to realize it's more engaging so they can push it to as much people as possible.
Thank you very much, Nhyira. I really appreciate
Okay.
that. That was wonderful. Thank you.
All right.
Yeah,
Okay.
I'm clear now. I'm clear now. Thank you very much.
Okay.
Thank you. Yeah.
Solo, your hand is up. You can go.
Thank you very much.
Solo. Yeah, Solomon, talk. Okay, I think Solo is not ready. So if another person has a question, you can raise your hand and then I'll call you in. Okay, Jemima, you can come in.
Yes, sir, please. The last time I was following your videos with the consolidated financial statements, and I
Right.
saw that you were doing in case a parent has an associate, but its subsidiary has control over that same associate. The parent has direct control. And I saw that you had to calculate something before it shows that the parent. So I want to know the way it's calculated and
Okay.
the reasons
Are
behind
you doing corporate reporting or financial reporting?
financial reporting.
That is not your level.
Oh, okay.
Yeah. What I was doing was in a corporate reporting class. So that particular treatment, it is subsidiary. So that is for your seniors, the corporate reporting students.
Oh, okay. But since we are doing FR and corporate reporting in this video,
Yeah.
I wish you could say something. I want to know.
Okay. Then let me do it for you. Give me a
Okay.
moment. Okay, so this is what it means. Let me draw this closer a little bit. So if, for instance, we have a parent company and we have a subsidiary. Now, let's say the parent has 80% ownership in the subsidiary, meaning NCI is going to be 20%. So let's say that the subsidiary is also Gaga. So he has also gone to acquire another company. So we have subsidiary. So let's say that the company they acquire, they own 70%. Now, this is a complex group structure. So the question we ask is, how do we calculate the NCI in the subsidiary? That's a big question. So in order to calculate the NCI in the subsidiary, we have to calculate the controlling interest in the subsidiary. And the idea is that whatever investment the subsidiary makes, the parent has its share of ownership in that investment. Let me take that again. Whatever investment the subsidiary makes in the sub-subsidiary, the parent has its share of ownership of the subsidiary in that investment. So the first thing we do is that we will calculate controlling interest. So this is controlling interest in the sub-subsidiary. How do we do that? We will take 80% of the 70%. So this will become 70% times 80%. That will give us what? Who has a fast calculator to punch for me? Let me see. 0.8, 0.7, that's 56%. So this is 56%, meaning P has 56% in the sub-subsidiary. So the NCI of the sub-subsidiary will be 100% minus 56%, and that's going to be 46%. So this is how we will compute the NCI in the sub-subsidiary. Another thing is that sometimes, as the subsidiary has an investment, the parent will also have an investment in the same company. Now, what do we mean by that? Let's say P owns 70% in S. So NCI here is 30%. Then there is another company, sub, and S owns 52% of that. And then the parent company also has an investment in the sub of, say, let's say 25%. Now, let me make this 35%. I want you to follow me carefully here. You will realize that if we were talking solely about our subsidiary's investment in the other company, we would have treated it as an associate, because this is not up to 50%. So if you check closely, you realize that P's controlling interest here includes both a direct control and an indirect control. So if we want to check the indirect control, it will be 70% of the 35%. And that will give us, let's get a figure for that, 0.35, 0.35, and then 0.7. So that's 24.5%. Now you got to be careful here. This is their indirect control. Then they have a direct control of 25%. So when we now add the two, that is going to give us 49.5. Now, as you can see, both the direct control and the indirect control is not up to more than 50%. So still, this investment or this company here will not be treated as a subsidiary, but will still be treated as investment in associates. Are you okay, Jemima? Jemima, are you good? Your mic is off. So
I'm trying to get used to it, but I think it's okay.
Okay. All right. Uche Ijehu, you are asking on YouTube the meeting ID. I have already posted it in the chat. So scroll up a little bit, you will see the meeting detail. Someone's hand is on. Shino. Yeah, I think you can turn on your mic.
Good evening, sir.
Yeah, good evening. How are you?
Praise God. How are you too?
I'm also fine.
I'm trying to ask a question on ISA 16 under the revaluation. Whenever you have two period of should I proceed, sir?
Yeah, proceed.
Okay. Whenever you have two period of revaluation, and the first revaluation was upward revaluation, then the surplus you treat it under the other comprehensive income. Then later also you have another revaluation, which is downward revaluation. The downward revaluation, is it going to be treated as expenses, or is it going to be set off against the previous revaluation surplus?
Good. It will be set off against the previous revaluation surplus. Now, if the loss is huge, that it cannot offset all the previous revaluation surplus, then the balancing figure will be seen as an expenses in the income statement.
Okay.
All right.
Thank you, sir.
Okay. I see Huawei Y9 something something. Who is that? You can talk.
All right. So, sorry, this is Solomon.
Okay, Solomon.
Yeah, but I was making a contribution and then the line went off. We had a light off, so the laptop went off. Right. So I was just saying that a young man was complaining about the challenge he has in reporting foreign currency related transactions. So I was saying that in my current place of work, what we do is that we report in pounds, we report in dollars, Norwegian currencies and all that. So mostly at the end of every month, what we do is that depending on the report, Owanda is a recognized website where you can pick exchange rate across every currency. So you pick that the date of the report, we have the rate for that particular report. If it is that you want the report to be dated, say maybe 30th March, when you go to their site and you go on 30th March, you get the exchange rate. So all you do is to pick it, and then you come and convert all the, for instance, if it is in Ghana cedi, or if it's in CFA, you convert everything into dollars. So at the end of the day, you see that you have your local currency, and you have the translated currency, and then your report is good to go in whatever currency you want to do. So that was what I was trying to share with him.
Okay, that's awesome. So this is to user laptop. I forgot, you mentioned your name, but I forgot. So Lord is saying that you can visit Owanda.com. This is the address. And that will help you to get the exchange rate on the date of preparation of the financial statement, so that you can use that to translate the financial statement. So you can check this website up in case you don't know about it, Owanda.com. Thank you very much, Solo. Uche Ijehu, your hand is up. You can unmute your mic and talk. For YouTube guys, comment below with your questions in the chat box and give us a thumbs up on the video. Okay, give us a thumbs up so that YouTube can share the video to as much people as possible. Uche, you can talk. I think Uche is not ready. All right. Any other person with any question? Okay, I see another hand lifted. Yeah, Bernard, you can come.
Can you hear me now?
Who is this?
Hello. Hello, can you hear me now, sir?
Who is this?
This is
Bernard.
Bernard. Yes, sir.
Yeah, I can. It's better now.
Okay. So I was asking of we're treating IAS 8, where we were talking about changes in accounting policy and those things. And we were told that there are some instances of which you can select accounting policy, you can change it. That is one when IFRS update or they bring in a new policy or whatever. And then two, they said that it should be as the management board can use judgment something. I was confused and I want to be cleared on that judgmental issue.
Okay.
So basically, that's my question.
The concept is that, like you mentioned, there are two ways, or there are two reasons for the for changing accounting policies. Like you said, the first one, when the International Accounting Standard Board changes an accounting standard, new IFRS, certainly we will have to change. But the second one is that if in management judgment, the adoption of a new accounting policy or a change in accounting estimate will give a reliable and will make the financial statement more relevant, then they can adopt a new accounting standard. So it's about their judgment making their financial statement more relevant and more reliable by adopting a new accounting policy, then they will do it. Does it make sense?
Yes, sir. Yes, sir. So please, a follow-up question. I hope I can ask you.
Yeah.
Okay, so in the course of making it reliable and relevant, does that mean that you have to combine the qualitative something? I think he made some statement, but I have forgotten. He said that he, as a manager or management board, you have to come together and then use some qualitative something about account. I've forgotten that aspect. I don't know. So the question is, how can I make the accounting policy to be relevant and then reliable?
Okay, so this is it. Let's say, for instance, the company bought an asset, and then they bought an asset at a cost of, say, $20 million. And at the date of the acquisition, the company decided that they would want to have an economic useful life of the asset of, say, 20 years. Then they've used the asset for about 5 years, and now the carrying value of the amount of the asset is $50 million. Then something happens, and then the company revalues the asset. Or they did not revalue the asset, but they sat down and said that we've used the asset for 5 years, now remaining 15 years. However, the way the asset is now, it can't work for the next 15 years. So the company decides to change the accounting estimate. So you realize that here, it's about the judgment on the productivity and what the entity is getting from the asset. So they will decide that now the economic useful life of the asset should be just 8 years. Now, that's a change in an accounting estimate that they are using in that case. Why did they do this? They do this because they realize that the asset will not be there in the next 15 years. At most, it will be here in 8 years. So they now making this change will make the financial statement more relevant, more reliable in relation to that. That is what we mean by the concept of management exercising its judgment. Or maybe they were capitalizing an expenses. Then they realized that it's not good to capitalize such expense because even though there is no direct accounting standard there, now we want to expense it out. Because when we expense it out, it will be more better, it will be more favorable, because even this expense, we are not likely to get any future economic benefit. So something they were capitalizing earlier, now they will decide to expense it off because in their judgment, they are realizing that to make the financial statement more relevant, more reliable, and the financial statement will actually represent the nature of the transaction under consideration. This is what we mean by that.
Okay, thank you, sir. Thank you so much. Please, I heard of retrospective and then prospective.
Prospective.
That is, yes, in the course of policies and estimates. I want you to help me in getting the real meaning for these two terms, retrospective and then prospective.
Now, retrospective application simply means that when you adopt a new accounting policy to enhance comparability of the financial statement, you must go back to at least the just ended year and adjust the financial statement as though you had adopted the accounting policy previously to enhance comparability. So that is what we mean by retrospective application. So when you adopt a new accounting policy, it is going to change your current year financial statement. So because you want to compare current year to previous year, you will adjust the previous year financial statement. And based on the judgment, the organization can decide how many years back they want to adjust. But prospective is where it's about accounting estimates. With that, the change affects only the current year and then in the future.
Okay.
That's the meaning between retrospective and then prospective.
Okay, so it means literally retrospective means that is the English term, going back and then making some changes and then, yes. So going back and then making changes to affect current year, and then prospective means starting from current year to the future.
That's right. That's right. Okay.
Thank you so much, sir.
Okay. Okay. Whose hand is up? Let me see. User laptop. I think, I don't know if it was hand up or thumbs up. You can talk if you want to talk.
Hello?
Yeah.
Am I on? Yeah.
Yeah.
Oh, thank you. Please, I would want you to help me to shed light on the term substance over form.
Okay.
Yeah, please, I want you to help me.
What did you say your name was again?
Taiwo from Togo.
Okay, Iowa.
Taiwo.
Okay. Now, substance over form is actually one of the fundamental accounting policies, which we did in KG2. If you are not in KG2, you won't understand. Now, substance over form simply means that in the recording of transactions, we will record the substance of the transaction over its legal form. So let me explain to you. This is what it means. Let's say I lease a property. Forgive me about my markers. I don't have markers. Let's say I lease a property. So I lease a property from Jemima. Right. Now, the property I leased from Jemima leased it for me $1.2 million per year, and I leased it for 10 years. Now, that property is now used by me. I direct the property, and all economic benefits of the property flows to me. So, Jemima will remove this property in her books, sorry. So it will not be in her book, but the properties will now be recognized in my books. Now, does the property belong to me? No, it doesn't. Because when we go to court right now, the ownership, legal title of the document of the asset will still be in the name of Jemima. But the economic nature of the transaction is such that I control the property, and every money, every inflow, every economic benefit, service potential from the usage of the property doesn't go to Jemima, but comes to me. So because I control the asset, according to IFRS 16, leases, I'm going to be accounting for the transaction as such. This is what we mean by substance over form. So if we take the legal form of the transaction, I'm not supposed to include it in my books because legally it's not mine. But because of the substance, the economic nature of the transaction, I control the asset and every benefit comes to me. So I recognize the assets in my books and account for the transaction as a lease in relation to that. That is what we mean by substance over form. Iowa, are you okay?
Hello?
Yeah, you are on.
Yeah, I'm okay. But further, I want to ask, at the expiration of the lease,
Yeah.
what accounting treatment will Nhyira give?
Okay. Now, we will account for it in accordance with IFRS 16. So, by the end of the lease term, the value of the assets in the book of Nhyira will be 0. Then, Jemima will take over the ownership of the assets. So, according to IFRS 16, we will account for the transaction, and by the end of the 10 years, the value of the asset in our books will be 0. So, it will just be transferred or given back to Jemima. Are you okay?
Thank you. Yes, I'm
Hello,
okay.
Nhyira.
Okay.
I'm okay.
Hello.
Yeah, Jemima.
Nhyira.
Yes.
Okay, Zuche, can you hear me?
Yeah, Uche, I can hear you.
Okay. Where I want to ask my own question is on consolidated financial statement.
All right.
The treatment of current account, transfer of current account by either of the parties.
Okay.
Yeah.
Now, I believe when you say current account, you mean intra-group trading, trade receivables, and trade payables, right?
Is it that? Okay. Yes.
Is that what you meant?
Yes.
Okay. Now, when it comes to consolidation, what is going to be happening is that this is the parent company, this is the subsidiary. We are going to assume in our example that the parent sells goods to the subsidiary. So, at the end of the year, the subsidiary owes the parent, and the parent will be receiving money from the subsidiary. So, in their separate financial statement, the parent will have, as part of its trade payables, how much the subsidiary owes them. Then, no, not payables. Sorry. Debtors. Because they will be receiving money. So, as part of their debtors, they will have how much the subsidiary owes them. In the subsidiary's book also, as part of their trade payables, they are going to be having how much they owe the parent. But when we are preparing the consolidated financial statement, we are seeing the two companies as one. For that reason, no one is supposed to owe somebody. So the question then is, how much S owes P would have to be cancelled out on the group on the group cancellation. So this is what I mean. So if we write trade payables, this is on the consolidated financial statement. We'll bring the parent figure, we'll bring the subsidiaries figure, then we will subtract how much the subsidiary owes the parent. So when we bring the parent trade payables, subsidiaries trade payables, we will subtract how much they owe the parent company. Then the same thing will happen to the trade debtors. In the trade debtors, when we bring the parent figure, we bring the subsidiaries figure, we will subtract how much the parent will be receiving from the subsidiary from it. And that is how we do and deal with the current accounts. Do you understand?
What if it is a current assets, transfer of current assets?
Okay. Now, so transfer of current assets can be in two ways. Okay. So let's say goods in transit and then cash in transit. Is this something, is it what you are talking about?
Yes.
Goods in transit and cash in transit?
Yes.
Good. Good. So with goods in transit, what happens is that we push it into the account of the person supposed to receive it. What does that mean? It means for the goods in transit, we will add it to the inventories on the group financial statements. So when it comes to the inventory, when we write inventory and we bring the parent's inventory, we bring the subsidiary's inventory, we will add goods in transit. But this is where you got to be careful. You got to be careful here. The goods in transit hasn't yet been sold by the entity supposed to receive it. For that reason, you have to calculate provision for unrealized profit on the goods in transit. Okay. And that provision for unrealized profit will be deducted. Because according to IAS 2, inventory must be carried at lower of cost or net realizable value. When there is a cash in transit, the same thing. We're going to push it into the account of the person supposed to receive it. In a simple language, it means when I write cash, I'll bring the parent's cash, I will bring the subsidiary's cash, then I'll add cash in transit. But let me make it more understandable for you with some figures. So I am assuming that parent is selling to the sub. So we are going to crunch some numbers here to help us understand what we're doing. Now, in the books of the parents, they know that they are going to be receiving $20,000 from the subsidiary. But subsidiary knows that they owe the parent $12,000. Listen to this carefully. The reason for the discrepancy is because of goods in transit, which is valued at $8,000. So how do we do the treatment here? Simple. This person, 20,000, no problem. So like I told you, we will push the goods into the account of the person supposed to be receiving. So this is going to be still 20,000, and this, we're going to be pushing the 18,000 to them so that we will now have 20,000 across board. So if we are preparing the consolidated financial statement, what do we do? And this is what I want you to get very well. So when we write trade payables, we will bring the parent's trade payable, we'll bring the subsidiary straight payables, then we will subtract how much the subsidiary owes the parent, which is how much? $12,000. We will subtract it, $12,000. But when it comes to trade debtors, we'll bring the parent, we'll bring the subsidiary, then we'll subtract 20,000. Why? Because this is the figure in the books of the parent, and this is the figure in the books of the subsidiary. Uche, are you okay?
Yeah, thank you.
Okay. Jemima, you can come. Yeah, Jemima. Jemima, I can't hear you. Hey, YouTube people, comment below with your questions. I'm going to be answering all of them. And give us a thumbs up, okay, on the video to make it more engaging for YouTube to push it out for us. Jemima, are you ready? Okay, Bernard, come. Looks
Yes,
like
sir.
Jemima is not
Hello,
ready.
sir.
Yeah.
Okay, so sorry for distracting you tonight. You were dealing with consolidation and ahead of goods in transit and then cash in transit.
Yeah.
So I want to ask that when do we normally get goods in transit and when do we get cash in transit? Because when we're dealing with consolidation, there are times that you will see that trade receivables and trade payables, that of a parent might, let's say, be 2,000 Ghana cedis. And when we go to trade payables, you will see something like 15,000. But we were told that we have to do a cancellation. Here is the case that we have 2,000 here and we have 15,000 here. So I think, I don't know whether that is when we introduce in goods in transit or cash in transit. I don't know which is
All right. So let me answer your question. Cash in transit means that the person owing us has paid the money. But even though he has wired the transfer, the money hasn't hit our account as at the day or as at the day of preparing the financial statement. So what is going to be happening is that the figure as part of our debtors, if the parent is the one selling, will be different from the figure in trade payables from the subsidiary. Why? Because they had paid 8,000 to these guys already. So in that case, like I said, we will push in the cash in transit to the person to whom is supposed to receive it. But at the end of the day, in their books, they have 20,000. For that reason, still when we are dealing with debtors, we will still bring that 20,000. And when we are dealing with creditors, we will bring this 12,000. But that 8,000 cash in transit will be added to the cash. So when we bring cash, parent, sub, and then we will add the cash in transit in relation to that. But it means different figures will be deducted in relation to the trade payable, trade receivables. So goods in transit is where the seller sends the goods to the buyer, but the buyer doesn't receive it as at the date of the preparation of the financial statement. Whilst cash in transit is where the buyer pays the money but has still not received or is not received by the seller at the end of the period as at the date of preparing financial statement. So that is the treatment.
Thank you, sir. Thank you so much. Please associate, and then we have associate, and they said that associate normally they are associated with significant influence. And then when we come to that consolidation, we said that they have control, parents have control, and for associates, they have significant influence. So I want you to help me in understanding it very well, that when we say you have, we know of the figures that they are saying if you get 50 plus, it means it is control. But then when we have something like 20 plus, we are saying that it is significant influence. So I want to know the difference between these two terminologies.
Good. So when we say you have significant influence, it means that you participate in the making of financial and operational decisions of the organization. And when we say you have control, it means you don't just participate, but you make the final decision. So,
Okay.
example, let's say we have a company, NP Group, and the board of directors, we have 9 members on the board. Always, it has to be odd because of the final decision. If you own about 35% of the company, it means you have significant influence. In that case, out of the 9 members on the board, you may have maybe 3 people. Which means, like, you have significant influence. When they are making decisions, you can influence how the decision stands out, but you are not the person to make the final decision. Why? Because you have only 3 people there. But if you have control, meaning you own more than 60% of the company, you call the shot. So out of the 9 members, you may have 6 people or even 7 people on the board. For that reason, you will call the shots, you will decide what to be done, you will decide what products to be produced and how financing will be made. So the issue about significant influence and control is premised on the number of people or the voting rights you have on the board. Does it make sense?
Yes, sir. Thank you so much. Thank you so much.
Jemima, if you are ready, you can come now.
Yes, sir. I was trying to ask, with derecognizing financial assets, we were told that if the risk and reward is transferred to the entity, then that's when you take it out of our books. I want clarifications on that one.
Okay. When it comes to sales, we will say the sales is completed when there is transfer of risk and reward. So Jemima, let me get your question clearly. You want to understand what it means when we say transfer of risk and reward. Is that what you want?
Yes, that's what I want. But I saw the risk and reward in financial instruments. So
okay,
it's relating to financial assets. Yes.
Okay, so this is what it means. Now, when we are saying you are transferring risk and reward, and by extension, this is not only to financial assets or whatever, it actually relates to all transactions of companies. So when we are saying you are transferring risk and rewards, it simply means that ownership, benefits, maintenance, and anything that relates to that asset has been transferred totally to the purchaser. For instance, if I say I'm selling this phone to you, and we agree that I'm selling it to you at, say, $200, but even though I've sold it to you, I'm the one still using the phone, and you come in maybe 2 times in a week to come and take the phone to go and do something, and then you bring it back to me, then I have not sold it because it's with me, I still use it. Economic benefit flows to me 5 days a week, and I maintain the phone, I charge it, I buy data, I do everything for it in relation to that. So in that case, we would say that risk and rewards has not been transferred. So it is not a sale. But if you pay the money and I don't, now the device can be with me, but I don't have any rights to use it. I'm supposed to keep it down for you and you will come for it later on. In that case, we will say that risk and reward has been transferred. So risk and reward simply has to do with maintenance, operational, economic benefit. Who is it flowing to? If it is substantially flowing still to the seller, then the sales has not been fulfilled. But if it's transferred to the one buying it, then certainly we say the sales has been fulfilled. Jemima, are you good?
Yes, sir, please, I'm okay. But I want to make a scenario so you see where exactly I'm coming from.
Okay.
So for instance, if a company sells an investment in shares, but retains the right to purchase the shares at any time at a price equal to their current fair value, do we say the risk is transferred or not?
No, because of the repurchase option, it means the deal is a financial liability. It's a financial arrangement. And they use the shares as a collateral facility. So that is a financial arrangement. So it's like you are borrowing me the money and I'm using the shares as collateral. Because as far as I have a right to buy it back at any time, it means I did not sell it to you, but it was a financial arrangement. Jemima, are you okay?
So you don't de-recognize it or you de-recognize it?
No, you cannot de-recognize it because you've not sold it. Just that the money you receive will now be recognized as a financial liability and interest will be computed on it and will be accumulated over the years.
Oh, okay. I
Yeah.
get it.
Okay.
Okay, thank you.
All right. Any other questions? Let me see. Okay. So if you have any other questions, you raise your hand and we can, I can let you in, then you can ask questions. YouTube, if you have any questions, you put it in the chat box. I'm reading all of your comments and we'll be answering all of them for you. Let's see if I have any comments on YouTube. All right. So any other questions for me? Those of you on the call here on Zoom? Yeah, Uche, Ijo.
Okay. In cash flow statement, I'm taking you out from consolidated. In cash flow statement, how do you calculate the tax paid?
Okay.
Yeah, I'm still finding it difficult to get my tax paid.
It is very easy. So when we are dealing with cash flow statements, one of the things that is critical is the computation of the tax paid. So in order for us to calculate the tax paid, what we do is to prepare the tax accounts. So how do we go about that? So I'm going to put a T account pro forma to enable us to do the income tax. Now, as always, two separate financial statements are going to be given to us. So we are going to bring the opening balance. Now remember, when it comes to tax, there are two things all the time: the current year tax and then the deferred tax. So if it is the current year opening balance, that is the previous year figure, will be brought. Then if the deferred tax opening is also a liability, we will bring that up, DT. Then we will pretend to close these accounts like this. Then we bring the closing balances. So balance brought down, current year, balance brought down, deferred tax. Every brought down has a carry down. So balance carry down, current year, balance carry down, deferred tax. Now, please note that this is just a pro forma, meaning the opening balance will be an asset. If it is a deferred tax asset, we will bring it on the debit side. And if the closing balance has a deferred tax asset, it will also be on the debit side. So that is something you must note. Now, after we bring this opening and closing balances, always from the statement of financial position, what we do is that we go to the income statement or statement of profit or loss. Then we'll pick the income tax charge for the year. So the income tax charge for the year will come on the credit side because it will increase our tax liability. And that will be picked from the income statement. So once we pick that, we balance this account. And always, as far as we are preparing the cash flow, the credit side will be more than the debit side. And the balancing figure is what is called the tax rate. So this is how you calculate your tax in cash flow.
Okay, thank you very much.
All right. Bernard said, thank you. Hope this is not to be the last time. Thank you once again. Okay. Oh. Yeah, it's not going to be the last time. The whole of this week, we are putting it down for Q&A sessions. So especially the whole of this week. So we're going to be having some sessions. All right. So who else has any other question? Bernard, Iowa, and Uche. Is there any other questions you have for me to address? Let's see our YouTube device. Yeah, Uche.
Yeah, on Fitzgerald, okay. Beauty blog. Can you throw more light on that model?
Okay. I think I did a full video on that on my Facebook page. I don't know if you've seen that.
Yeah, I asked for it the other day. I don't know why I'm not able to open that video.
Oh, okay.
Yeah.
So let me see if I can do something about it here.
Okay, thank you.
So when it comes to performance evaluation in general, there are three key modules that can be used to assess the performance of organizations. The first one is the balance scorecard by Kaplan and Norton. The second one is the building block module, which is where your question is, by Fitzgerald and Moon. And the third one is the triple bottom line. So these are the three things, but your question is on the building block, so we'll look at that. Now, the building block module is just a build up of or is an evolution of the balance scorecard. According to Fitzgerald and Moon, the balance scorecard is not able to be used really for service organizations. So ideally, it's for manufacturing organizations. So for service organizations, how can we assess their performance? According to them, there are three broad categories into which we can assess performance. The first one is called dimensions. Then we have standards. Then we have rewards. So these are the three broad categories. Now, according to Fitzgerald and Moon, when it comes to dimension, there are two things we have to look out for: results and determinants. Now, the results refer to the outcome of decisions that management has made in the past. The outcome of decisions that management has made in the past. That is what we mean by results. Then the determinants are the key areas that an organization must focus on in the future to be profitable and increase its financial performance. So results are the outcome of the decisions, the policies that management has made in the past, and the determinants are the key areas of focus for future profitability and financial performance. So, according to Fitzgerald and Moon, there are about 6 things we must understand when it comes to the dimension. So, we have financial performance, we have competitiveness, we have quality, flexibility, innovation, and resource allocation. So these are the 6 dimensions: financial performance, competitiveness, quality, flexibility, innovation, and resource allocation. So what do we mean by these things? Results can be measured from financial performance and competitiveness. Why? Because if we want to look at the outcome of decision management has made in the past, we will have to look at the financial performance. So the policies they implemented, how much sales did we generate? How much profit did we make? Well, were we able to control our costs? That is financial performance. Then, for the decisions they've made in the past, how competitive have we been? Have we increased our market share? Have we become more competitive as an organization? So if we want to look at the outcome of every policy the company has implemented in the past, Fitzgerald and Moon said we need to look at financial performance and the competitiveness. However, sustaining profitability and gaining competitive advantage means producing a quality product. So according to Fitzgerald and Moon, quality, flexibility, innovation, and resource allocation, these 4 things are called determinants. Why? Because they are the key areas the organization must focus on in the future in order to increase profitability and financial performance. Then they said that once we understand our dimension, once we know everything about the quality level, the fact that we have to be flexible because we are living in an environment, a changing environment, the fact that we must be innovative because again, people's tastes and preferences are changing. The fact that we have limited resources and we must allocate our resources well, we must set standards. So once we understand the dimensions, we now set standards. What are standards? Fitzgerald and Moon said that standards are the benchmark or targets against which the performance can be measured. The benchmark or target set against which the performance can be measured. So if we want to measure financial performance, we must set a standard for that. So standards must be set for each of the headings and the dimension. So when it comes to quality control, we must set a standard. When it comes to innovation, we must set a standard. When it comes to how competitive we want to be, we must set a standard. But there are three aspects of standards we need to look out for. So according to Fitzgerald and Moon, for any standard to be successful, there are three things to know. Number one, we must ask ourselves, who is responsible for the standard? Who is responsible for the standard? That means ownership. Who is responsible for the standard? That means ownership. So if you say we are increased profitability by 20%, if you say you are increasing revenue by 15%, if you say our quality must meet ISO standards, who is responsible for that? Because somebody must be responsible for the standard you are setting. So if it comes to quality, definitely our production department, our quality control division will be responsible for that. When it comes to increasing in the sales or revenue, our selling and distribution department must be responsible for that. When it comes to increasing our profitability, then our cost and management division, as well as our sales department, must be responsible for that. So when we set a standard, the first question we must ask ourselves is, who is responsible for the standard? That is ownership. But Fitzgerald and Moon went ahead to say that it's not enough to ask who is responsible for it, but the next one is, at what level is the standard set at? That's the second question. At what level is the standard set at? So when we say at what level is the standard set at, we are talking about achievability. Because if you are not careful as a company and you set too high standard, it will demotivate employees and they may not be able to achieve it. If you set too low standards, they will not also innovate and bring out their best. But you've got to be careful that you are setting the standard in such a way that it's not too high, it's not too low, but it's achievable. That is the second aspect. Is the standard set at a level, or at what level is the standard set at? That is achievability. The third question we ask ourselves about standard is that, can the standard be used to appraise performance across the organization? Can the standard be used to appraise performance across the organization? That is what we mean by equity. So the standards that we've set for the various divisions, quality control, production, sales, accounting and finance, all the divisions, the standard we've set for all of them, is it fair? Is it okay? can you use that to assess performance or appraise performance across the organization? Because if you tell the sales department that they should increase sales by 50%, but you tell the production department that they should increase production by 10%, then, I mean, what's happening here? Is it that you are giving these people some holiday and you are giving these people more work to do? So that is the third thing, equity. So once we understand the dimension, we set standards, and three things must be looked out for. Who is responsible for the standard? What level is the standard set at? And can the standard set be used to appraise performance across the organization? Then Fitzgerald and Moon concluded that, hey, for you to achieve your standards, there has to be a reward system in place. Because if you tell me, Nhyira, I want you to increase sales by 50%, I will ask you, madam, what am I going to get in return? Or what is my share in the deal? So in order for me to achieve the standard, you need to put in place a reward system. So the reward system, according to Fitzgerald and Moon, must be linked to the HR of the organization. So it means we will reward you based on your level, based on your standard, and everything. But there are three aspects, again, when it comes to the rewards. According to Fitzgerald and Moon, when we are talking about rewards, number one, we must ask ourselves, do employees understand the reward system? That is what we mean by clarity. Do they understand the reward system? So if, for instance, you said, Premium, I want you to increase sales by 20%. And if you do, we will check and see if we can give you something. What is that? You can give me what? There is no clarity. So I'm not going to be doing it. But if you say, Premium, if you increase sales by 20%, we will add $5,000 to your salary. Then I understand it because I know the standard you set and I understand the reward system attached to it. But not only that, the second thing or the second question we need to also ask ourselves relates to the issue about, will the reward system motivate employees or drive employees? So let me put it this way. Will the reward system drive employees to achieve the standard? Will the reward system drive employees to achieve the standard? That is what we mean by motivation. Will it drive employees? So if we say, Nhyira, I want you to increase sales by 20% and it will give you $5,000, will it drive me? This is where Abraham Maslow's hierarchy of needs will come in, because we would have to know the level of need of the employee so that we can set a reward system that will drive them. So if I have a phone, I have a tablet, I have a laptop, and you tell me that if I increase sales by 20%, you will give me a tablet, I don't need it. I already have one. But if you say, Nhyira, if you increase sales by 20%, I will promote you. That may drive me better because promotion means more salary in relation to that. Then the third question that Fitzgerald and Moon talked about, let me see. I'm trying to remember it, but I can't recollect. Let me see if I can get it from my slide here.
Controllability, isn't it?
Control, I love that.
Yeah, yeah.
I love that. Do employees have control over their work? Do employees have control over their work? I mean, like I've disconnected my device, so I'm not able to do it. Give me a moment. Let me reconnect my device. 820. Okay, so that's it. Okay, so will or do employees have control over their responsibility? That is controllability. Now, why is this important? Because if you set standard for employees and you are also telling them how to achieve the standard, it may demotivate them. However, if you monitor them and you give them the room to find out how the standard can be achieved, they may be able to what? Achieve the standard. So for instance, if you tell me to increase sales by 20%, don't try to tell me what you think I should do. No, I will know how I can increase the sales. Maybe I can go to the mall, speak with the mall, and we can sign a contract with them, or I can go to the schools and sell the products there, or I can go to offices to sell the products there. So don't tell me how I should do it, because it will be like you set a standard, then you're also telling me how to do it when I'm not comfortable with it. So are employees responsible for the standard that you've set for them? That is controllability. These are what you have to understand about the Fitzgerald and Moon building block. Does it make sense?
Thank you very much. I know the factors there, but to link them up was my problem.
Okay, yeah. So now you know how to link them.
Yes, yes. Thank you very much. I appreciate.
Okay. Yes, Samuel Quasin, you are on YouTube. You are saying hi there. Hello, Samuel. Today we are doing a Q&A session on financial reporting and corporate reporting on Zoom. But I think you didn't get the details earlier. But if you have any questions, Samuel, and all of you watching on YouTube, you can comment below and give us a thumbs up on the video on YouTube so we can get more engagement on the video so that YouTube can push it, because that is the way YouTube will be able to push the video so we can reach as much people as possible. Okay. All right. So when it comes to the issue about corporate reporting and financial reporting, let me give you a general tip, then we will be signing over or signing up for today. So in order for you to excel in corporate reporting and financial reporting exams, there are a couple of things you must understand and focus on. And if you're a follower of my work, I've mentioned this over and over again, but I gotta say it again. Number one, you've got to be strong in the accounting standards. Very, very important. Make sure you understand all the accounting standards. Don't be selective. So understand all the standards. Now, you know, on my YouTube channel, I have the videos on almost all the standards. I think only about 2 or 3 of the standards that we don't have. But when it comes to the standards, what standards are critical to the exams? The following standards are critical. In other words, whether you like it or not, you are going to meet them in the exam hall. The first one is my favorite, IAS 4, income tax. So it's a standard, you've got to make sure you understand everything about that. Now, for those of you doing corporate reporting, the deferred tax aspect is more dangerous than just the normal tax aspect, because you do deferred tax in leases, you do deferred tax in share-based payments, and you do deferred tax in also the issue about employee benefits and those things. So for corporate reporting students, it's a key area. Then, regular customer, IAS 16, property, plants, and equipment. So certainly, it's something you must understand, because something about depreciation, revaluation of assets, and for your information, deferred tax is also here when it comes to IAS 16. But this is what I always say. IAS 16 has some standards connected to it. So if you are doing IAS 16, property, plant, and equipment, you must look at the connective tissues that are coming together, like IAS 20, government grant. Because if we purchase a property, plant, and equipment, and the government gives us a grant, we must use the deferred income approach to identify that grant and account for the asset in accordance with IAS 16. Then, IAS 23, borrowing costs. Because there are times when if we are acquiring a qualifying asset or constructing a qualifying asset, we will have to go and borrow money. And when we borrow money, the cost of arranging the funding, the interest expenses, all of those things would have to be capitalized. But we have to determine the capitalization period and non-capitalization period. So IAS 23 is also something critical we must understand. Then, the third aspect, still under IAS 16, is the issue about IAS 40, investment property. Because there are some times where the examiner will examine us in such a way that we are moving from investment property to owner-occupied, or from owner-occupied to investment property. So you must understand how to do the treatment when we are using an asset for day-to-day running of the organization, and now it becomes an investment property. So when you're dealing with IAS 16, these three guys, you must make sure you know how to treat them together. Then the next three standards are also very basic, and that is IAS 36, impairment of assets, IAS 37, provisions, contingent liabilities, contingent assets, and then IAS 38, intangible assets. So these are also three core accounting standards that you make sure that you understand everything about them, because they are basic and could be embedded in the question. Other accounting standards that is not always that we may see question on, but there may be a footnote on it in the single entity financial statement, is IFRS 15. Contracts from revenue from contracts with customers. There could be something like that there, dealing with the issues of sale and lease back, dealing with the issue of sales where we have continual services. That is also something that we need to look out for. Then there are some times when, along with the single entity financial statement, the examiner will ask us to calculate the earnings per share. So we're going to have IAS 33 earnings per share. So basically, these are, then let me add financial instruments. Another key area, IFRS 9, financial instruments. So these are some of the standards that before you walk into every financial reporting or corporate reporting examination, you must make sure you understand them. Now, for those of you doing corporate reporting, in addition to understand these basic ones, you must add the following: IAS 19, employment benefits; IFRS 2, share-based payment. So in addition to understanding these basics, these two guys would have to be added for those of you doing corporate reporting. So once you build your understanding on these accounting standards, you are good to go. That's the first slide. Now, from the accounting standards, financial reporting students, you go to the single entity financial statement. Now, for you to excel in the single entity financial statement, you must be strong in the accounting standards. Because like I say all the time, all the footnotes in the single entity financial statement is an accounting standard. So whether you are preparing the cash flow statement, you are preparing a statement of financial performance, you are preparing a statement of changes in equity, or you are preparing a statement of financial position, irrespective of the financial statement you are preparing, all the footnotes will be an accounting standard. And the accounting standards will be among what I have listed here. So when I tell you to be strong in the financial reporting standards or the accounting standards, I am actually using one stone to kill two birds. You will be able to get questions on the standards and also be able to do the single entity financial statements. Now, once you are done with that, you come to the third slide, which is interpretation of financial statements. Remember here, the focus is always about not the computation, but the interpretation. I have done a two-part series, I guess, on the interpretation of financial statements, where I gave the guideline on how you can interpret the financial statement. In case you've not watched that, make sure you go and watch that, because it's not enough to compute profitability, to compute gearing, to compute liquidity. You must understand how to interpret it. And in your interpretation, we want to see the connectivity, how you relate ROSI with asset turnover, how you connect asset turnover with the inventory trade turnover, how you compare the asset turnover with the trade receivable days. So the connectivity of the interpretation is what we highly want to see when you're interpreting the financial statement. So why do I go with this approach? I go with this approach because students struggle with consolidation. So like I say, don't answer console first. Be strong in the accounting standards. Once you are strong in the accounting standards, you are going to answer the question on the accounting standard and you do single entity. And I have done series on the interpretation. Build your understanding well, and then you come there. Then in every financial reporting and corporate reporting exams, you're going to be seeing the issue about theories. So you go to the theories, and then you answer the theories. Now for ICA Ghana, the theories will be on ethics. I don't know about Nigeria, Uche for you. Then also about the conceptual framework and regulatory framework. Whether you like it or not, the examiner will set theory questions on these two guys in the exam hall for ICA Ghana, to be specific. Whether you are doing corporate reporting or you are doing financial reporting, it's going to be there. So once you are done with these guys, then you can go to the favorite topic, which you all like, and that is going to be consolidated financial statement. I don't know why students like console like that. They like it, but they can't solve it. I just don't know. It's like they know hammer, but they can't solve anything. Now, In consolidation, I have also done a series on consolidation and it's available already on my YouTube channel. So you can check the group financial statement playlist, and then you can look at I explain group structure, net assets, NCI, group retained earnings, intra-group trading. You will understand all the principles. So for financial reporting students, by the time you get to console, you have already passed the exams. So your standards, superb, single entity, superb, interpretation, superb, the theories, you've cleared it. So by the time you get to console, like you're already cruising after your pass mark. And so that will be the last thing you will do, and that's going to be consolidation or consolidated financial statement. Now, in the exam hall, I want you to take time to read the questions very well. I have also shared examination strategy already on this channel, so you can check that video out as well on the channel. The examination strategy on how you can read the questions, and always start with what you can do best first. This is what I see students doing. Like I said, many students are too egotistic. So they'll pick the console question. After 1 hour, they realize they can't do the console. By that time, you're already failing. So you start panicking. And maybe you could answer the theory. Maybe some of the standards you could have answered. Or maybe you could have done some of the work on the single entity financial statement. So I want you to make sure you read the question thoroughly and you'll be able to go through it. Now, for those of you doing corporate reporting, apart from the accounting standards, interpretation of financial statements, the theories here, you guys will not have single entity, but you have one of the two topics, business valuation, and then corporate reconstruction and corporate reorganization, or financial reconstruction and corporate reorganization. So one of the two will be in the exam, or in addition to your accounting standards, interpretation, theories, consolidation, and one of the issues, business valuation, or the issue in relation to financial reconstruction or corporate reorganization in relation to that. So this is the structure, and my recommendation to you is this. Make sure before you get to the exam hall, understand these standards, and you can do it. Don't tell yourself, oh, Nhyira, it's difficult though. Even if I learn cry, I don't understand. Stop saying these things. You can understand. So don't say, oh, even if I learn, that one you're already cursing yourself, even before you start learning. How can you curse yourself like that? So be confident in yourself, watch the lecture videos, and solve as much questions as possible. If you do that, you can increase your chances of passing your financial reporting exams and passing your corporate reporting exam. So this is the structure of how I want you to position yourself for the examination. Joseph Edu and Isaac Nana, you guys just joined. Do you have any questions for me? Nana, you have a question? Okay, on YouTube, Samuel Quason is saying that, please, what about IFRS 5? What is IFRS 5? Asset held for sale and discontinued operation. Yeah, that is a standard you can look at, but like the fact that I didn't add any standard here doesn't mean it's not necessary. I am just saying that before you go to the exam hall, at least you have to know these standards often. So certainly IFRS 15 is critical in relation to that. Then someone said, and IFRS 16 leases, Yes, leases is also an accounting standard that the examiner can throw at you, but it's not something that is fundamental that every semester examiner will throw it at you. So it is something you can look out for. I am just here listing what I consider to be the core standards that almost every examination sitting, the examiner sets questions around them. So IFRS 5, certainly you have to look at it somewhere. IFRS 16, certainly you can look at it. And I have videos already on these standards on my channel, and you can check it out. And if you have any questions about them also, you can ask. Yeah, Joseph Edu, do you have any questions for me? You just joined. Your mic is off, so in case you want to talk, you can turn it on.
No, there is no question for now.
Okay. All right. Right, so that is basically what you have to understand about corporate reporting and then financial reporting. So we've addressed a couple of questions from you guys and issues about consolidation, intra-group trading, accounting standards. We've dealt with a couple of issues today here, and I believe that this session has been fruitful for you guys. For those of you who joined the stream late, you can watch the playback of the video always on my YouTube channel, and you see how all the questions that came were superb questions from various aspects, from various things in relation to that. My objective, as always, is to be able to meet you on this one-on-one and then provide you with the assistance you need in relation to that. Okay, so I was said, thanks so much. It was an impactful session. God bless you. Amen. God bless you also for joining the stream today. Okay, so someone said, thank you. So please, how do we go about answering corporate reporting? All right, someone. In answering corporate reporting, as always, build your understanding of the accounting standards so that you can go to the accounting standards and answer that. And then interpretation of financial statements, build your understanding as well on that. So you can go there. Then question 5 is what I call no man's land area, where the examiner will bring questions on ethics and the questions on conceptual framework and some current issues. Chances are about 15 marks of the 20 marks in the question 5, you can answer them. For sure, there is a 10 mark between a 6 to 10 marks question on the ethics. So it is something you have to go for. So that's how I want you to structure yourself. Either you start with the standards, or you do the theories first, or you do the interpretation. So among these 3 guys, do them first. That is my recommendation. Now, after you do these 3 guys, then between the question 3, which is the business valuation and or financial reconstruction and corporate reorganization, you can decide between that question and the console which one you want to go for. The reason is that you don't have time. And if you start thinking in the exam hall, you will start failing. Chances are the console question will cause you to think. Because a lot of times, students think they know console, only to realize they don't know anything. That is why I recommend that there are cheap marks for the accounting standards, easy marks for the interpretation, easy marks for the theories. Why not go for them first? So that you will save some time and go and pour it on the consolidation as well as the question 3, which is a business valuation or financial reconstruction or corporate reorganization. So someone questioning, that is how I will recommend that you go about in answering the financial reporting questions. As always, make sure you take time to read the questions properly. Because many a times, students don't read the questions well. Either they are not reading all the questions or something like that. So you got to take your time and read all the questions and understand the requirements of the questions very well in order for you to answer it in relation to that. So some more questions, that is how you go about corporate reporting and answering the question in relation to that. Okay, some more questions said appreciation. Thank you very much. You are welcome. So if you are watching on YouTube, please give us a thumbs up on the video and share it if possible. That way, the video will be engaged and YouTube will realize that the video is being engaged so they can promote it to reach as much people as possible. That is the objective, so that we can reach many people, and that is how YouTube works. So help us in relation to that. Okay, so basically this is where I want to conclude on for our discussions today. Unfortunately, we did not start early because we had technical problem. There was light out, so I had to actually travel from home to our school here so that I'll be able to do the stream. It was just when I wanted to do the stream, the light went off, and I can't just cancel it because of doom so I quickly traveled to be here so that I can still have the discussions with you. That is why, or that was why we started a bit late in the stream. So probably tomorrow, hopefully, it will be the same. It will be 4:30 as always. And tomorrow we'll be looking at some other 2 subjects in relation to that. And that will be communicated on the YouTube channel, on my Facebook page, as well as all other platforms, so that you get a notification about it. Okay, so that is it about it today. I will conclude here today. And thank you guys for joining us. Uche, Jemima, Bernard, Iowa, Solo, Samuel, Daniel, like everybody, and then Joseph, everybody, thank you very much for joining the stream. And I will see you same time tomorrow, 4:30 p.m. as we continue with this executive Q&A session with me, as I address your questions and help you to prepare well for your examination. So you take care of yourself. Now remember, coronavirus is still here. We now have over 4,700 cases as of the day today that I'm recording this video, or we are doing this stream. So make sure you sanitize your hand, wear your face mask or nose mask, and you take care of yourself. So all the best, and I'll see you same time tomorrow. Bye-bye.